Hello, everyone, and thank you for joining us today on our KJH Insights podcast. I'm Sarah Bull, Managing Partner at KJH Investors. It's our first podcast in 2026, and as always, our goal is to provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I'd like to welcome Andrew Sumerick here today. He's a portfolio manager and member of our investment team. Thank you for being here, Andrew. I'm really looking forward to reviewing the key trends that shaped 2025 and some of the important themes we are watching for 2026. So, how are you, Andrew?
Yeah, I'm great. Thanks for having me today, Sarah.
Yeah, well, it's super excited. We've obviously got a lot to talk about today, so I'm glad you're here. So, Andrew, let's start with a year in review. The KJH investment funds and strategies performed really well. They had a strong performance year in 2025 across the board. And it's interesting, though, when we look back on the year, there were a lot of crosscurrents. So there was definitely a lot of stories or themes underneath that strong performance. And this week we had our annual investment meeting for clients, and you and the investment team talked about some of those themes. So, can you recap what we discussed for our listeners?
Yeah, I think you rightfully pointed out there was a lot going on, and there's also a tendency to forget some of those things. And you look at the headline numbers, or if you just looked at the S&P 500 up around 18%, you would think that's a pretty good year, which it was, but it really doesn't tell the story of what occurred because there was a lot that investors had to deal with over the course of the year, and it was anything but a smooth ride. So we kind of just highlighted a few that even when we were looking back, you don't forget about them, but it's, oh yeah, that was in 2025. And the first was even DeepSeek, which I know not a lot of people may have heard that name in a long time, but in January, it was the Chinese startup claimed to have developed an open source large language model in just 2 months and really for a very small amount of money. And it really shocked the global tech world, and it called on the entire AI trade and those companies and their multi-billion-dollar moats into question. And so Nvidia, actually, the poster child of AI, stock dropped 17% in a day, and trillions were wiped off the stock market. So that was how we started the year, where AI had been the driving force for the previous year, and there was a lot of enthusiasm for it. And we kind of got that basically over a weekend where people were trying to digest the DeepSeek. And then obviously we moved further to March and April, and a lot of tariff turmoil. Tariff announcements by President Trump caused bond yields to spike, stocks fell, corporate America basically shut down as every multinational was to redraw their supply chain maps almost overnight. And we saw the S&P 500 drop 19% in just a few short weeks. The Nasdaq was down even more, 25%. So some people forget we had basically a mini bear market just in the spring of 2025. And then geopolitical risks became a primary concern as well. We had the Israel and Iran conflict in June. Everyone was on edge there and wondering what the response would be from Iran. You had the US even join, so there was definitely heightened tensions in the region then. November, we had a government shutdown. I think it lasted 43 days, the longest on record. We had over 1 million federal workers not getting paid. Many economists trying to predict, would it knock off a full percentage point, maybe even two off of fourth quarter GDP. So we had a government shutdown to deal with. And then closer to the end of the year, geopolitical events came up again. We had Venezuela. There was tanker seizures in December, and obviously with Maduro being captured, a lot of that was sending shockwaves through the oil market. And then also Greenland. That's kind of been in the back burner for a while, but things really started to heat up in December and into January. And so it was just more headlines for investors basically to process. So over the entire year, we kind of wanted to remind everybody there was a lot of volatility. It was a wild year that doesn't necessarily show up when you just look at the 2025 S&P 500 total return.
I think that's a great summary of the key themes. And I think you're right. April, the market was down anywhere from 20 to 25%, depending on the market. And then you had a strong performance year up about 18. Is that not right? Is that not the sort of journey the market took?
That's exactly it. And then we had a couple more pullbacks over the course of the year. But even the makeup of those returns over the course of the year was actually very similar, maybe not as drastic, but this year as it was the previous 2 years. So We like to look at the equal weight S&P 500, which, as it sounds, it equally weights every company in the index, as opposed to the S&P 500 is cap weighted, meaning the larger companies have more influence. As an example, Nvidia is 8% of the S&P 500 today. And so when you look at the equal weight last year, it was up around 11%, and the S&P 500 up 18%. So companies like Nvidia and the AI winners were some of the big reasons for the discrepancy between those two. And really, that is going back 3 years now, where the cap weighted has outperformed the equal weight. But in addition, last year, I think we, especially being here in Canada, the TSX had a very good year. It was up 28%. Gold was a really big driver of that. The metal itself was up 65%, and gold companies were up, 100 to 150%, depending on which company we're talking about. So about a third of the TSX return was from gold. And so that was kind of the makeup of the year. You saw commodities do really well in the precious metals and the base metals space. But looking back on that equal weight, we kind of think the average stock was probably up around 11%. And then you had some big winners in the commodity space and winners in anything kind of tied to the AI theme.
And those record highs in gold driven by Fed rate cuts, geopolitical tensions. What else? Just peel that back a bit.
Yeah, gold is very unique in the sense of, where the demand comes from, and a lot of it is currencies, interest rates. People like to use gold as a safe haven, and so there's many different reasons that are likely driving the underlying demand of gold, and really being able to narrow it down to one is pretty difficult. But you're right, it's central banks that are buying more and more gold, as opposed to treasuries. Just different ways of transacting has all driven demands kind of away from global currencies and maybe a lack of faith in the fiat system. And so that was a bigger driver of that, combined with commodities in general had a pretty good year based off of there's been so much underinvestment. If you look back in the 2010s, 2010 to 2020, and even up to the last couple of years, the underinvestment overall in commodities has just meant there's not a lot of supply for any increase in demand that may occur.
And we've talked about equity markets and the rally in equity markets in 2025. Fixed income bond markets, the Fed easing contributed to a rally in treasuries. How do you summarize the year on our credit side?
Yeah, the best way to on the credit side, it was actually pretty calm, even in the times whenever we had all the noise that I was talking about, and even the tariff tantrum. Credit spreads held in relatively well. Yields, they moved around a little bit. They were rising during the time of the main tariff turmoil, but overall, I would say yields at the beginning of the year and the end of the year did not move all that much, aside from the short end, where both central banks in Canada and the US were easing. And spreads tightened a bit over the course of the year, which really indicates a strong corporate market, strong access to capital. And so I would say our fixed income and credit mandates was a lot of coupon clipping, as we call it, or carry, which is just generating yield off of the coupons that the bonds are paying. And it was actually a relatively quiet year compared to 2022, where we had yields skyrocketing, and then 2023 and 2024 you had them maybe renormalizing. It was actually a normal year, which is actually good for risk assets, right? People just kind of want to know less changes is better, less uncertainty is usually better. And so that's how I would characterize the overall credit environment for 2025.
Thanks. That's great. And I think this might be a good spot for us to launch into 2026 then, right? Because the KJH investment team are really going to be watching the Fed here and rates. So let's talk about some of the themes and look ahead to 2026, and maybe start with your thoughts around an easing cycle or where you think rates are going.
Yeah, as we head into 2026, it's definitely probably the most topical right now is where the Fed is at in the easing. I think the US is going to continue to ease rather than tighten at the moment. Obviously, we have a new Fed chair in place as of recording this, and so everyone's trying to digest what that's going to mean. But I think regardless of who it was going to be. The overarching factor was they wanted somebody who was going to help lower rates further. And I think even taking all the questions around Fed independence out or how many cuts it will be, generally what markets care about is the path. If it's 2 cuts this year, if it's 3 cuts, if it's 1 cut, it's usually just the path that matters more as opposed to really trying to figure out on what date they're gonna do what. And also the other important thing is they already have been easing, and so interest rates operate on a lag. Once you lower rates, it generally takes time similar to when they were raising rates. It takes time for that to work its way through the economy. So we think that will benefit small and medium enterprises. A lot of companies that operate off of floating rate loans, they now are going to be paying less going forward. They're going to see that in their cash flow statements. And so we do think that's going to help the economy. Other things that we think will help in 2026 is government stimulus. So we've got the big beautiful bill that was passed, which will provide lower taxes, going to benefit consumers and corporations. And another thing that hasn't been talked about as much lately, even though it normally is top of mind, is energy prices. And they've actually been coming down, whether you look at any type of energy prices, but the biggest one being oil. And really, I think why it matters is this is almost the most immediate impact on consumers, right? You see it when you're driving down the road, you see it every day. It's front and center as opposed to those interest rates, which may not impact you as much until you go to refinance something. And so really having energy prices in check is important for the economy as well. We've got the midterm elections, which is something we're watching. I think that's going to be a very tight race. And generally speaking, the government's probably going to do whatever they can to run a good economy to try and win those votes. So that's something to watch. And then labor market, we're always mindful of that. We always say the economy can ebb and flow, but really recessions occur whenever the labor market rolls over. And when you lose your job, that's whenever you really make changes and structural changes in your decision making. And it's been soft for years now. I think if you were to have seen a massive spike in unemployment, it probably would have happened by now. And I think that's just a function of the rolling or uneven economy that we've had, different industries recovering at different times. And so we're kind of in this muddle along scenario, not only for the economy, but also for the labor market. And I guess the last one would be AI productivity. I think we're seeing it through most corporations today. It's starting to make its way through. Companies are just going to be even more and more productive during this AI super cycle that we're in the middle of. And so those are kind of the positive things for 2026. But that doesn't mean that there aren't any risks. Did you want me to walk through some of the risks?
Yeah, because I think you've just done a good job of really explaining kind of what's bubbling beneath the surface. And so I think two things here. One is that's a good sense of the macro landscape. But as I always say, what keeps you up at night? And then what are some of the areas you have conviction around?
Yeah, I think our biggest things that we're watching this year are the long-term interest rates. If we do continue to run the economy in a little bit hotter and it's up and we still don't have inflation at 2%, you could start seeing the long rates rise. And that is usually what can really hurt markets. So the Fed can control short-term interest rates, but long-term interest rates are driven by the market. So that's something we're watching. The second one would just continued protectionism in the US. I mean, the market has handled it relatively well so far, but with every day a new headline from the president, a lot of the actions I mentioned before in 2025 didn't have serious repercussions. And so does that mean he continues to be aggressive and who knows if he oversteps? And I think that would be a risk in 2026. We're definitely watching the Mag 7 AI bubble, whatever you want to call it. If there's any hints that there's a slowdown there or a step back, I think this could be a bigger issue for the overall market because it's been such a large driver of earnings. And so these mega caps take up around 35 to 40% of the S&P 500. So as they go, so would the headline market. And then valuations they're elevated, they're higher, so it's no secret there. The market understands things are pretty good for risk assets at the moment, so we need earnings to come through. And we've really been saying this for a while, and maybe that's where I'll turn to. You asked, where are we focused? Where do we have more conviction in areas? And we really do believe the market needs to broaden out here. And we think this actually might be the time it will. We've had a few head fakes but there's a bit of a setup that we think the market will broaden out. And the reason really, you need to take a step back to what's really been going on in the economy. It's been a sluggish economy for a while now. It's been bolstered by AI, and it really masked the underlying strength or lack thereof of the economy. So, the print of GDP, it was everything seemed fine, but the economy itself and the S&P 500 earnings have really been driven by the AI and technology theme, but we think that's changing. Not to say that that theme won't continue. It's a strong secular area of growth, but it's going to have its ebbs and flows. The economy's been going through an uneven recovery, still making its way to a post-COVID shock, and we're seeing reasons to believe the average business can take the baton and grow earnings going forward. And we look back in the last 4 years or so, the S&P 500 has compounded returns at around 12% annually, whereas the Russell 2000, which tracks 2,000 smaller companies, has averaged just 3.5%. So this divergence, it can happen over short periods of time, but the prolonged 5-year, 4-year gap is particularly notable. And as we mentioned, lower interest rates helping smaller businesses. Most of them borrow at floating rates. So this will start to flow over the stimulus, helping them with lower taxes. And really just the recovery being inconsistent, certain sectors seeing extended slowdowns. Business economics generally recover as struggling companies either go bankrupt or exit the industry. So we think this helps stabilize the market. So all of these factors flowing through, we're actually finding a lot to do. It's a bit refreshing compared to the last few years where earnings growth was so dominated by artificial intelligence and other technology themes. We're finding a lot of opportunities in many different industries. So that means we're broadening out our portfolios as well. Reducing positions in some of the mega caps doesn't mean that we don't think they're incredible businesses or there's this massive bubble to pop, but just finding other places to allocate capital that really hasn't been the case for the last few years. And so you combine a look back and how we feel about 2026, all of that kind of leads into a broadening of what we think will be the market and our portfolios.
And we should probably think about wrapping up here soon. But last thing, what about hard assets? Because we talked about gold in 2025. What about hard assets into 2026?
Generally, we haven't talked much about them, and Sarah, you know this. They're pretty cyclical businesses, and commodity prices mean the businesses are price takers. But we also try and invest in strong secular themes, and we believe hard assets do have a nice setup going forward. So it's getting a lot more attention in the media. Governments paying more attention to national security, energy independence, and just overall trade. And so for any commodity, the main driving force is supply and demand, and we think both of these likely favor higher prices. So why do I say that? So why are we kind of changing our tone here? Let's just start on the supply side. There was massive underinvestment in commodity exploration for over a decade, as I talked about earlier, and call it the 2010s. And the reason this is important is base metals, the lead time to build these mines are extremely long. Copper, as an example, from point of discovery to actual production, most consider it to be around 20 years. Not to mention the incredible amount of capital is needed. So we're entering a time where there's little new supply will be coming in the next 5 to 10 years due to this underinvestment that occurred in the 2010s. But then when you look at demand, it varies by the commodity, but there's two driving forces where we think demand actually is going to be higher for base metals than just a normal world would be with GDP growth. So one is governments. I touched on that. They're viewing base metals and critical commodities as a national security rather than just, a normal commodity. So this has led to strategic stockpiling, domestic production incentives. Nations are really rushing to secure reliable supplies of some of these, copper, nickel, lithium, stuff like that. The world order is shifting and countries are realizing globalization has left them to rely on other countries for some of the critical materials. And then the second demand driver is more longer term and secular, and that's the energy transition and electrification of everything. So movement to EVs, renewables, artificial intelligence, all of these consume a lot of base metals. Copper is probably the best example. Demand used to just be driven by building construction because a building would have a lot of copper in it, but it's the best conductor and it's now needed for all the increased demand in electricity. So in my view, or our view at the moment, it's you can't overlook hard assets at this time. They're certainly volatile, but we're entering a phase where demand appears to be rising more quickly, and the supply to meet that demand should have started 15 years ago, right when there was that underinvestment.
So, Andrew, I think we're getting to our time here and have really enjoyed recapping 2025 with you and having a chance to look back on the tariffs that we hadn't seen tariffs like that in over 90 years. And as you said, the AI fueling the market. And then 2026, some of these big themes that you've just talked about midterms, beautiful bill, the easing cycle. I think all of those are really big themes that are providing some opportunities here, but also reasons to keep you on your toes. So, anything else you're thinking about or that you want to mention before we wrap up?
I think something I've been thinking a lot about, just the headline risk versus what's maybe really going on. And it seems to be every year it gets louder and louder. And whether that's just social media, the news in general, or our access to information, there is so much noise out there that, yes, we deal with on a daily basis. But it's also, a lot of it is noise. I mean, we talk to companies every day. And a lot of the time, we ask them about these headlines as well. And they'll say that's not what's happening on the ground per se, right? Like it's just, a lot of it is negotiating, a lot of it's political. And so I just maybe hesitate to take everything you read with a grain of salt. And really our focus is talking to those companies who are actually operating on a day-to-day basis to try and differentiate between what is noise and what is actual. And so that would maybe just be my advice, just as it seems to get louder and louder every day.
I think that's a good point because most of our investors have long time horizons and the noise just creates the short term volatility in the marketplace. But as you've talked about, there's a lot of opportunities to be investing in good businesses that have good long term prospects. I think that's a good reminder because there is a lot of noise.
For sure.
Okay, Andrew. Well, thanks. Really value your opinion, and I know our clients certainly do too. So thank you for joining me, and thank you to our listeners for joining us today. We'll be back next month with another issue of our KJH Insights podcast. Wishing everyone a good month of February and a happy family day. If you have any questions, please reach out to your portfolio manager, and we'll continue to provide you with commentaries and updates as the market narrative unfolds. All of those are available on our website at kjharrison.com. We look forward to speaking to you again next month. Be well.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.